Randy, it's been a huge year for private credit. So how would you describe the demand that we've seen so far in 2025? Did it surprise you?
Well, it surprised us a little bit coming out of April Liberation Day, but month after month, we've seen an increase in demand, particularly because of uncertainty in other asset classes. Given the fact that the Fed now is lowering rates, there's concern about, hey, what's going to happen to yield? And just uncertainty in general, Greg, in the market has driven a lot of investors to a more stable asset class.
Can you talk about the spike in demand from the wealth channel? Because financial advisors are now offering private credit to their clients, and they never really did before.
So institutional investors have paved the way, in particular, the need for a stream of income, a yield that's a premium to the liquid assets, and also the ability to continue to deploy no matter what's going on in the macro markets. I think the thing that's driving interest right now is the fact that given rates coming down, look at relative yields. We continue to be a couple hundred basis points ahead of where the liquid assets are trading.
What are some of the most frequently asked questions from financial advisors to you over at Churchill if they want to get into the business of offering private credit?
So the biggest differentiator is there's a big tent in private credit. It encompasses a lot of things. So direct lending, which is where we are at Churchill, focusing on middle market companies that are service oriented, really in the US. These are companies 50 to 500 million in revenue, focusing on how do we get value out of that asset class. With private credit, it's about stability. So these middle market companies don't trade, they're private, and they don't flow with, the values don't flow with what's going on in the macro markets.
Why is the middle market a good place to be for private credit?
Well, considering what's been going on since COVID with interest rates and the Fed moving things down, and look at tariffs. So a lot of the tailwinds that we're experiencing now as a result of the middle market being sheltered from that, and the headwinds that the macro markets have been experiencing were really with large cap companies that had more global exposure.
And why is private credit a good place to be in a so-called K-shaped economy where the rich are getting richer and the lower middle income classes, they're buying down now?
Yeah, well, middle market, if you think about the overall economy in the United States, these companies that are medium-sized businesses, it's actually the third largest GDP in the world. They also represent a significant amount of growth, both in terms of the revenues of these businesses, as well as the employment. So it's actually a good place to be. We also invest with private equity firms who are putting their own money into these companies. So the deal flow that we're getting is kind of a curated flow from the best of the best.
And then finally, this is a chance for you to talk your book. You've been doing this for quite a while, but there's a lot of new entrants into the market now. Does that give you pause?
Well, only 5% of the managers who are here today were here prior to the Great Recession, and we're one of them. I think the other thing is partnerships. So we're owned by a $1 trillion asset manager, TIAA, that's both an insurance company as well as a retirement fund. And all of the business that we do with our third-party investors are also loans that are being done with TIAA. So everybody shares in everything, and we're completely aligned with one of the best investors on the planet.
All right, well, thanks a lot for coming on and talking about it.
Thanks, Greg, very much.